Thank you very much for joining. I know that there will be a couple of more people that'll come on. We are recording this webinar, and also I just give it in full disclosure. These are not recommendations or opinions per se. What we're trying to do here at 180 Markets is, friends, we know it is a tough market out there, but what we're trying to do is to bring you value in different ways. And one of the ways out there is a systematic trading / investment system or strategy. And one of the benefits of it is to frankly get rid of the biggest enemy in the world, in the room, which is bigger than the market itself, which is that enemy between your ears, and to really give yourself some type of structure and framework. And that's why we're thrilled to be joined by Stock Nostradamus and its founder, Michael D., because Michael has such a system, and importantly, and we're definitely going to get into this, not only does it tell people when to buy, but it tells them when to sell. And what you'll find over as you look through so many great investors is they tend to, not all of them tend to be great buyers of companies or instruments, but they do all tend to be pretty decent about selling. And with that introduction, Michael, welcome to 180 Markets.
Thanks, Greg. And yeah, that's a brilliant quote, isn't it? The greatest enemy to the investor is likely to be himself or herself, as the case may be. I couldn't agree more.
Yes. Now, Michael, maybe before we get into your win-loss percentage, which is just incredible, I mentioned it's a stock picking system. Can you just tell us a little bit, what is Stock Nostradamus?
Sure. What we do is use mathematics, and in the mathematics, we're inputting just share price to create volatility indices. And from those volatility indices, we measure, interpret, and then work out what it is that volatility index is telling us. Now, what I can, we're going to talk about this, but what I can prelude is that we can see advance warning of share price behavior or stock behavior about to occur. And that makes things relatively simple when you've got that, because if you know what's about to occur, i.e. upside or downside, it makes it so simple as to what you need to do. And so that's what we do.
Right. Okay. So to be clear, it's a volatility-based system. It's not necessarily based upon valuation metrics. It's not necessarily based upon price momentum as in terms of a trend following system.
It is absolutely not based on any of those things. What it is based on is an absolutely new and unique way of analyzing the market through changes in volatility.
Okay. And you said it's a new system, but also what you have done, and we've spoken about this before, is a lot of back testing. Can you just talk about that a little bit?
Sure. We can backtest through history, whatever event or period of time we like. But truthfully, backtesting is riddled with problems if people pick and choose the events and the timing and the prices that they execute at. So one of the things that I was insistent on right from the beginning was we always record our buy price at the end of the day and our sell price at the end of the day. And the timing of them is what we promote to our clients anyway. So you can backtest our system through whatever period of time, as long as we've got data, and it creates what is a very solid history of returns, which we haven't talked about yet. But our platinum recommendations since the start of 2015, just for the sake of choosing a date, have only made one loss out of about 400 recommendations at the time of sale. And the rough, and I'll say rough because my mind just hasn't got the exact figure, but the rough return per recommendation is in the order of 15%. So we went through and lived through coronavirus. We can talk about that later if you will, and had an incredible result because coronavirus, of course, was the ultimate piece of chaos, and what our volatility system is attracted to is chaos. It loves, and it is not fearful of all of the change and all of the volatility that happens so often that most people would rather avoid.
Okay. Now, how it works for people out there that are listening, they want to know, and I want to know, how can I take advantage today? What is your system? Are you a fund manager? Are you a recommendation system, a new service? What are you?
Yeah, sure. Um, my history is as a fund manager. I worked for QIC for 15 years as the small cap manager and the backup manager for the big caps and the property trusts and you name it. So I've been through all regime of investing.
Right.
And I've run.
Just to pause you for 1 second, just for people that don't know, QIC is Queensland Investment Council, a multi-billion dollar fund manager.
Yeah.
Sorry, keep going.
Yep. And then I ran my own boutique for many years and ran IMAs for people. And what I realized was the skill that we could bring to bear in an IMA setting was for few. And I mean 2 dozen, maybe 3 dozen if you wanted to spend half the night on all of the admin. But what I wanted to do was be able to give I view this system as a bit of a gift. And I view that our mission is to help people, particularly retail investors, do something positive with their investments. So what I wanted to be is this system had to be scalable and it had to be flexible and it had to be able to be offered to as many people as possible. That means I don't transact, or we don't transact on behalf of our clients. We don't hold their money. We don't have any benefit in whether they trade with $1,000, $100,000 or $1 million per recommendation. What we are is a recommendation service. We use our maths to construct what the right stock is initially, the right timing is of the buy and the timing of the sell. That's what we do. And we sell those recommendations via our app, which is called Stock Nostradamus, which is hard to say.
Excellent. And one of the things, Fred, that we do think is attractive is it is just so easy to hop on, so to speak. You pay, correct me if I'm wrong, Michael, you pay per recommendation. So therefore, if at any time, it's almost like you can opt out whenever you want. Nobody's forcing you, or there's no hidden fees or nothing of that nature. So from that respect, it's certainly super easy, very low risk from a trying point of view. And obviously, and Michael and I have discussed this, if the recommendations are working for people, they're certainly going to come back for more.
Yeah. And that's what we want. We want to live and die on our success. And I feel extremely confident that if people are prepared to give us a go and give it the appropriate time, they're not going to be disappointed. Of course, not every recommendation makes 15.9% as they did in the last 12 months, but some make 5 and 7%, 10%, some make 30 and 40 and 50%. So in some ways, there's a little bit of luck in which stock you choose and the timing of it, but one way or the other, 100% successful in the last year and only one loss out of 350 over the last almost 8 years. So there's reason to be confident in what you're doing and to just stay the course.
Right. Hey, Michael, I called it when I sent over some information to you, the elephant in the room question. So I'm going to ask it now.
Yeah.
What makes your system so good? And that obviously you can share with us.
Yeah.
System so good. And I guess also potentially, where do others come apart? But I'd really like to focus on what makes yours so outstanding.
Sure. So just to recap, we create, measure, and interpret volatility change. And what that means is, quite simply, you understand it, all of the listeners probably understand that volatility is another word for certainty or uncertainty. And as volatility rises, uncertainty, let's just think of the word uncertainty rises. As uncertainty rises, share prices are falling. And if we had our first recommendation, therefore, is to sell. When volatility is rising, share prices fall, so you sell. Now, it's not as simple as that everyone could just run away and build their own volatility system, which is proprietary, because about half of the time, that's what we recommend. About half of the time, we actually have to go to a deal of trouble, and I'm talking about tens of thousands of lines of code to diagnose the other circumstances that is what really makes you the money. So from our point of view, we understand and know of the inverse relationship between volatility and price, and we use the volatility changes and the circumstances about the time of the change to reinforce our recommendation or create a new one. Because quite often the opportunity to buy comes quite quickly, and the opportunity to sell can come very quickly as well. Our average hold time is between 3 and 6 months, depending on which product. So implicit in your question, Greg, is quite a beautiful conundrum for people, and that is, why can't everyone do this? Because
Sure.
we all know that investing's tough, and it's difficult at a time like this. And as I've said to you, our numbers to the end of September still show excellent outcomes. There's two real reasons. The first one is we're human, and as human beings, we're hardwired to be emotional. And when we're emotional, we make silly decisions when we're doing things like investing in the stock market, because we are afraid and affected by the cacophony of noise that comes out of
Sure.
media and television and you name it, that waves over the top of us. And there's actually a subliminal effect that soaks into us. No matter what we try to do, it's in there, and it's a part of the decisions we make and the fears that we hold, which are also the basis of what we call investor biases. And you would have studied these and known these, but they're incredibly powerful. Now, being a human means that we're going to struggle to buy low and sell high, because what most people do is the opposite. They buy high and they sell low, because they don't really know how they got into that investment in the first place, and they waited for confidence to build, and as it built, they got more excited just at the time, no doubt within a few days or weeks, that things changed. And we all know that there are cycles within stock markets. So that's one big factor that I would say is probably one of our biggest problems as investors. Now, the second one, you look roughly the same age as me, Greg. I'm probably a bit older than you, but anyway, when I started to invest, there was a thing called persistence of information. And that was that you could buy a stock which was upgraded, or a new fantastic CEO, or an acquisition, and there would be a thing called the persistence of information effect. And that really was that the information would continue to give you a gift of return for up to 28 days. It was probably 25 years ago. Now, that was a wonderful thing as an investor. It was probably the easiest thing you could do to buy a stock that was being upgraded by analysts in the market or as a result of acquisition. Unfortunately, with the advent of no more selective briefings and the advent of the internet and the email system, the difficulty with that is everyone got the same information at the same time, and we were all trying to do the same trade. And it turned out to be an exercise in futility rather than making money.
Hedge fund crowding.
Yeah, exactly. That's the second reason why people generally struggle to make money in the stock market. Now, if I paralleled that to what we're doing, and just the last thing, when a stock has an information release, it actually has an effect which is to cause the analysts in the broking houses and the institutional investors to stop everything and pick up the screaming baby. Now, by that, I mean the one that demands the attention, the one that the release is on, or the new managing director acquisition, or whatever it is. It soaks up a huge amount of time. Now, when I was working as an analyst and even as a portfolio manager, I had somewhere between 50 and 80 stocks that I looked after personally, even with all the other things that I did. The reality is I couldn't look at 50 or 80 stocks every day. It just wasn't possible. There aren't enough hours in the day.
Certainly not in depth. No way.
No. And so the reality is that's what's dealt with the screaming baby. Now, mathematically, what we do is very different. We're casting our eye over every single stock, every single day equally, and we're giving it due attention. We're forecasting the share price behavior every single day for every single stock, and we're making the assessment of the buy, sell, or even hold decision every point of the way. And therefore, we're doing what people's minds, and particularly analysts, because their minds are already overloaded, simply can't do. So that's what we do. We recommend what to buy, when to buy it, and when to sell. And the outcomes we talked about are kind of magnificent and something that I'm enormously proud of.
Great. Hey, Michael, you said the system talks about when to buy and when to sell. I alluded it in the beginning of the conversation. There are numerous recommendation services of when to buy, when to buy, when to buy, when to buy, and that's always the chatter on the golf course tee. But very few people talk about when I just sold a stock. I just sold the stock. But a lot of times the selling is where you make the money. Can you just tell us for a second? Again, I know it's a proprietary system, but what generates your sell signals?
Yeah. So the reality is the same information that creates the buy creates the sell.
Okay.
So before I mentioned to you that when volatility was falling, share prices would be rising, and therefore we would buy at the start of that change. So as it started to fall, we would start to buy. In the same way as volatility means something when it's falling, it also means something when it rises. So if you think of that little cup
Sure.
at the bottom of our volatility indice, what that's telling us in the first instance is there's been a change and it's most likely to be negative. And then we work like blazers with the mathematics to confirm when the right time to sell is. Now, on our website, stocknostradamus.com, I put up examples from time to time, and I try not to have a very long time frame because it's hard to view it in graphics. But if anyone wants to have a look, you'll see the number of times the sell occurs and then the share price just tanks is remarkable. Again, it's not always the case that it's going to just drop away. It's either it's going to go flat or it's going to fall, and that's why we sell.
I understand. Okay, so volatility, from a one-liner, volatility precedes price.
Exactly. Brilliant.
Okay.
Yeah.
Okay.
So a change in volatility precedes price, and that's what gives this the power it's got.
Understood. And then another one of my questions on the selling is, do you, and you can answer if you want, do you use stop losses or is it just really based on vol changes?
No, it's all based on volatility changes. To be honest, we believe that a stop loss doing what we do, and I understand what other people do is different, and I'll very much qualify that. But what we do is we're trying to buy within bands of a price cycle. So let's just go back to where you finished off there.
Right.
Volatility precedes a price change. So once we see a change in volatility, we know that there's a price change coming. If it's a buy change, what we're trying to do, Greg, is buy in the bottom 10 to 15% of the price cycle and sell in the top 10 to 15% of the cycle. Sometimes we get it perfectly right, sometimes we don't. But in reality, what it means to be buying in the bottom 10 to 15% is we're there or thereabouts at the bottom.
Right.
So I don't stress if the share price goes below the buy price. I accept that because I know that in the fullness of time and in the balance of those probabilities that I just mentioned, one loss in 8 years.
Yeah, that's incredible.
We're going to make money. So even if it lost 10% or even 15 or even 20%, I don't stress. I actually don't even look at what happens between the buy and the sell. I wait for the sell. I look at it and go, you know what? That's fantastic. If I'd lost my head in the middle there and sold on a stop loss, I would have just missed on 20 or 30% return. So I
understood. Absolutely. And then, another question I had, and this is getting into the weeds a little bit, Michael, is we have obviously such computer strength today and computer modeling. I think that somewhere I read about 40% of the New York Stock Exchange volume is done on a systematic basis now. Within most algorithmic systems, they're constantly tweaking the system. Do you do something similar?
No, we don't.
Okay.
The reality is because we are based on one thing and one thing alone, and that's price. And the price becomes the basis of volatility, and the volatility is the basis of the share price behavior. What would we
Understood.
tweak? We could tweak it to be 10:15 or 3:45, but the reality is we don't need to. We're producing,
Understood.
yeah, we're producing what we're producing with great success. We don't need to. We're not feeding in economic variables. We're not feeding in what happened in China overnight or America overnight or whatever. We don't need to tweak.
Got it. Now, Michael, obviously, markets are always moving and there are different kinds of market conditions. You have seen a lot of market conditions through your system, but are there certain types of market conditions that are better suited or worse suited for your system?
Yeah, beautiful question. The reality is the worst market for us is a boring market.
Like a
And
slow grind.
a slow grind, a go nowhere, a little bit up, a little bit down, that really doesn't give us any great satisfaction. And I know it gives most people great satisfaction. So, and I understand that. Because we're looking for volatility to create the opportunities for us, we're looking for volatility. So
I
the
understand.
converse to your question is the best market, but the worst market is the one that just goes nowhere. The best market for us is one where there's change, because that
Right.
gives us the ability to use that brilliance and use that opportunity to draw ourselves into the volatility and make those calls to make money. Because we're not in this for any other reason other than to make good calls. And if we make good calls, we know that the clients will be happy and they'll keep using us. And if they keep using us, that'll be to their benefit and to ours as a business as well. So,
Of course.
yeah, so we're looking for those opportunities. Now, if I gave you the example of coronavirus, and I'm a little bit mindful
Yes.
of time, but
No, definitely.
coronavirus in
We're going to go
January,
over a little bit. I
I
hate to
think we
say it,
are,
but
because I can
okay.
talk quick.
But it is what it is. Okay.
January of 2020 was quite an amazing time, and you might remember, or people may remember, it was quite strong, the market. And into about the middle of January, towards the 20th of January, our system started to sell, and we were fully invested. We had about or over 20 buys that were outstanding, if you like. And I was watching the selling that began like the 20th of January and finished at about the 20th of February or thereabouts. And we only had 3 buys left. And I remember scratching my head and thinking, what's going on here? And we had oil starting to do some tricks, and we had this thing called coronavirus starting to make headlines a little bit. And I thought to myself, oh, this is strange. This is the biggest sell down of this system that I've ever seen. So I was watching it with great interest. And then within about 10 days, that market tanked 37%. And I thought to myself, in retrospect, I thought to myself, okay, and now I know what the event was, because the system doesn't say, Michael, it's coronavirus, it's going to wreck the economy for the next years, or it's an oil crisis or whatever.
Sure.
It just starts to sell or buy, whatever
Right.
the case may be. Now, we got through, and it didn't buy anything virtually until the end of March. It was 26th of March. And then I wrote a piece for our investors at the time, basically saying, the lunatics are out of the asylum. This is about as bad as it gets, because I could start to see the forward-looking indicators from our point of view being much more positive. Even though that was a risky thing to say, people were looking for a little bit of hand-holding.
Sure.
And the model started to buy very aggressively late March, April, May, and then by June, it had started to sell those positions out. Most people were still scared. All the institutions were saying that the market's going to hell in a handbasket. We'd fully invested into about the start of May, and we were really starting to make some superb returns. Now, cool thing about that is we saved 37% on the way down, and then we got to make it on the way back up, which again, I'm very, very proud of and very thankful of. That's a massive system. I can think back to 2008. Of course. I can think of 9/11, where as a human being, I was sitting in front of a screen in Brisbane, just staring at that image over and over and over again, thinking, wow, has the world just ended? And at some point, your fundamental brain kicks in and goes, I know what to do, and I'll start to do it. Again,
Right.
the beautiful thing about this system is it's constantly working on what's the right outcome, what to buy, and when to sell. So I'm forever thankful for what it's able to do. But those little corrections are happening all of the time. We're in one of them at the moment. And I was saying to a colleague yesterday, it fascinates me that we haven't seen much buy. In fact, we haven't seen a platinum buy in just about 2 months. And I was saying to him,
Even despite the sell-off.
this sell-off, there hasn't been any buying. Now, Greg, I'll share a little bit of news with you just before we got on. There are 2 platinum buys for today. Now, that's music to my ears, because I know now we're starting to see, and I'm not calling the bottom, but we're starting to see the system see that there's potential for it to go up. But if you think about those last 2 months, they were, on that real curvature on the way down. So with that, I was stoked to see it, and it just, even for me, who's used to dealing with the system, you're looking for the opportunities to confirm all of the time that what you feel is what you're seeing come to life.
Yeah. No, it's interesting because also I'm just trying to pull up as I'm speaking with you, the VIX, or the volatility index, is trying to break out as well. So I suppose it's not coincidental in nature between the two, between your program and the VIX, if you will.
I don't actually look at the VIX anymore, but I did study it. In 2007, I went to the trouble of actually going through the CBOE's handbook and work out how I could replicate it in Australia before I got onto what I've got onto here. And the thing that I realized about the VIX volatility is there's nothing forward-looking about it. You're looking at a technical chart and you're
right. Sure. Yes, that's exactly what I'm looking at.
But the actual number itself doesn't say we're going up or going down. And you would remember in the GFC, the VIX volatility got to 90%. And the meaning of that is that the stocks were either going up or down 90% in the next period of time, 3 months, 9 months, whatever it is.
Correct.
I just could never draw any real flavor out of the number. What you're doing is different, of course, so I understand that.
Right. What you're saying is that the VIX is a moment in time snapshot as opposed to a predictor.
That's exactly right. And as soon as I understood that, I knew I couldn't use it for investing in stocks in the way that I wanted to. And I had to make sure that there was more knowledge and I gained more, but I learned so much from understanding the VIX. It was a great thing for me to start on.
Great. Hey, Michael, before I want to open it up to questions, because I'm getting lots of, apologies, that's why my phone is ringing as well, because people are asking me questions and whatever it may be, and that's okay. I understand it, everyone. Do you have any closing remarks before I open it up to the Q&A?
Yeah, sure. One of the things you and I spoke about was how is it that people are to subscribe to the mental application of doing something in a routine way. You put it far more eloquently than I did. But how would you hold the line? How would you toe the line? And
correct.
Really, from my point of view, I thought about that after we spoke, and the reality is people are looking for a different way to invest because what they were doing didn't work. What we've got here is a system that works. And it works through time, and it's proven. And if you can get a comfort in that and the fact that there are very few losses over a long period of time, just one, then why would you intervene? It's only that you would think that you could bring something from your mind to actually bring an excellence to your investing to make you feel better at night when you were worried otherwise. So my comment, a wise man once said to me, why have a dog and bark too? The reality is if you're going to do this, do it and don't muck around. So that was something that I thought was good to get through. Look, we're proudly different and we're proudly successful at what we do, and we're independent thinkers. We're very different from the rest of the market, and I don't resolve from that. And therefore, I know that this will gel with some people and not with others.
Right.
We're doing exactly what everybody's mind can't. We're ASIC licensed. The app's for free. They can get that and have a play. It's not sexy. It's not exciting, but it's there to deliver to the individuals exactly what it is that they need to know at a period of time. So again,
Right.
we're predicting share price behavior and we're acting ahead of it, doing what people struggle to do with their own biases and with the reacting to information. I think I've covered it. The other thing to say, and
Yeah.
I'm sure before we get into questions, is I love to chat to people about their questions. So if anyone's listening and wants to schedule a 15-minute chat or something, I'm pretty sure my details are there, but if not, it's michael@stocknostradamus.com. Flick me an email, happy to talk you through. It's I actually quite enjoy chatting with people about what we do.
Yeah, and everyone, well, when there's a recording, we'll send that out with it as well, in case you don't, it happens to not be that fast as a writer as I am not myself. Okay, Michael, I'm going to start out with the questions. Someone's popped one up. Apologies here. Okay, just random. Sorry, guys, hang on one second. Okay.
I'm getting the same problem with me.
Yep. How many followers do you have buying stocks on your recommendations?
Sure. Look, we're in the hundreds. So we released this via an app about 9 months ago. So we're in that fast growth phase. So we're just beginning from this point of view.
Got it. And I'm going to take a question after that. Then is there a point where you would get a lot what I call a crowding effect, or are you investing in mostly big caps anyway, where it really just doesn't matter?
So we're about half big, half small. When I say small, I'm not talking about hundreds of millions. I'm talking about sort of in that 1 to 4 billion mark.
Oh, so still quite sizable.
Yeah. So they're still pretty big. We simply can't cope with stocks that don't trade. If a stock won't trade and won't give us a reliable price, we don't use them. So we're very, very seldom in the very small space. So does that answer your question?
Yeah, no, for sure.
There's no crowding when you're trading BHP or even ARB or Monadelphous. There's plenty of opportunity to invest.
Yes, no, and I certainly know that there's one company that we've looked at that's a multi-billion-dollar company. I don't know if we can mention it, but where it is certainly in that category of you could probably buy $10 to $20 million at a clip if you wanted to.
Probably every hour.
So yes, exactly. So that wouldn't be an issue. Like, another question I'm getting is, one of the most famous system traders is Renaissance Technologies. Have you ever compared yourself to them?
Well,
I'm not sure.
Yeah, look, the answer is no.
Right.
I've spoken to a lot of quant traders who wanted to use or quant funds actually, who wanted to use our system as an input to theirs. But by the time I explained the significance of what that would do to their system, it wasn't worth my time and it wasn't worth theirs. At the end of the day, what we're doing is just so different from anything that they could do. For us to be one of 40 factors isn't going to strengthen their model. They really need to push their model aside and replace it with ours.
Right. Got it. Another question, and this is actually a very good question, is the holding period. Do you have slow holding periods and long ones, or is it just all the same?
Good question. We haven't spoken much about our silver recommendations, but they're faster moving. And so they would be in the order of average 3 months. And the platinum would be more toward that 4 to 6 month period. It does change a little bit quarter to quarter. So yes, the silver is a quicker moving, but we're not day trading. And we're not even aiming to day trade. We're looking to make an investment. We're looking to cut out that middle ground between the bottom 10 to 15 and the top 10 to 15% and pocket our money so that we can make an investment another day.
Yeah, and friends, that's why one of the reasons we were so excited with Michael is that, as everyone knows, a lot of the 180 markets business is extremely fast moving. And one of the weekly complaints we get is that I missed something. Well, in this system, you're not going to have that same issue. So we're trying to solve that problem for you as well. That's just a little plug for myself. I can't help
That's
it.
Good.
Another question, and this is a very good one too. Your win-loss ratio is incredibly high. Would you be better having a lower win-loss ratio, but with more picks? It's actually a good question. Yeah.
It is a good question, and the answer is relatively simple. Our platinum literally has no losses and it returns 16%. Our silver
Right.
product has 90% win and a return of about, let's say, 10. We've got 3 products that sit underneath that, which are faster moving and lower level of profitability and a higher loss rate, so a lower
Sure.
success rate. At the end of the day, they sit there waiting for the right use. At the moment, I actually haven't got a use for them. But every now and again, there's a conversation that I have with people a little bit like this one.
Yeah.
But we'd say a stockbroker where they say, well, what we really want is something that turns over a bit quicker. And so that may actually end up being a product in its own right, quite separate from what we do. But for now, what I find is that most people are very, very excited by that platinum product and the win rate. So they're less worried about anything other than protecting their capital and making their money and then rolling it from one investment to the next.
Yeah, no, that certainly makes a lot of sense. Michael, I do unfortunately want to wrap up here because I know we have been going quite a bit of time.
Yeah.
Again, just coming back to that mental attitude, because I think it is so important. And if I want investors to understand, if they take nothing away from this call, how important it is to be somewhat systematic in nature. You've been a qualitative analyst, a quantitative analyst, if you will. What are your thoughts about that?
Sure. Look, the reality is, as I said before, there's not a lot of point in taking on a system and taking on a methodology like this if you're going to interfere. And so if you haven't been able to do it successfully yourself and you're wanting to try something new, then try something new and stick to it. And try to keep your mind out of it and start to read about investor biases and start to identify them within yourself. You'll be shocked. It's a discussion we could spend an hour on another day, but people would be shocked at how poor their decision-making becomes when they try to do things through the prism of the mind. We're absenting the mind, we're using the maths, we're creating the purest buy low, sell high decision that we possibly can. If you want to do it yourself, that's fine. Probably better to go somewhere else. So for me, it's the discipline of having the confidence to know this is going to work.
Got it. I will ask just a couple more questions. Apologies, everybody. Are your recommendations based on a technical trend change?
A technical trend change, as in charting, no. So everything
I think that's the question. I think that's what he's referring to.
The answer is actually categorically no.
And then, and I think that this is going back to different market conditions, this question. What is your track record going back 5 or 10 years?
Yep. So with the platinum, since the 1st of January 2015, it's a 99.8% win rate, and the return is just a touch over 15. I think it's 15.2. The silver is about 89% profitable, and the return number is in the order of 9.4%. So when we sell them, the platinum is a more expensive product, the silver is a much cheaper product, and quicker to turn over, so people have got more opportunity to redeploy their capital.
Got it. And again, I'll close with that. When you just said the cost, everybody, the cost is per recommendation. Don't like it in the future, don't use it. Like it, get more of it. So it's nothing locked in. Everybody, thank you so much. Michael, thank you. This really is differentiated. As I mentioned, we are recording it. We will get it out to people. I know a lot of you, unfortunately, that are not listening now do want to listen. Thank you very much, everybody. And Michael, thank you.
Oh, thanks, Greg. And look, I really appreciate your time. And for those that have listened, I very much appreciate yours as well. Don't forget to reach out, Michael, at stocknostradamus.com if you want to have a yarn. Thank you.
Bye-bye.
Bye now.
Thanks for watching another episode of 180 Markets Off the Charts. If you want access to thousands of capital raises, sign up at 180markets.com.au and you'll get access to our very next capital raise. Thanks for watching.